Good day, everyone. Today, we will dive into the critical aspects of transfer pricing, the methods used to determine whether transactions between related parties, such as subsidiaries or division within a multinational enterprise, are conducted at arm's length. The arm's length principle, which we've discussed before, ensures that related party transactions reflect the prices and terms that independent parties would agree upon in comparable circumstances. So this is a key concept in transfer pricing because it prevents profit shifting and ensures a fair allocation of tax revenues across jurisdictions. So we will explore the 5 primary methods recommended by the OECD and accepted by tax authorities worldwide. In this particular module, I will explain in detail the transfer pricing method, including when to use it and how to apply them. So it is basically different from the explanation we had during the fundamental principle of transfer pricing, which is the arm's length principle. So now let's go into details. Now, transfer pricing methods provide the framework for ensuring that related party transactions are priced fairly and comply with international tax regulations. The 5 main methods we will cover today include the comparable uncontrolled price method, the resale price method, cost plus method, transactional net margin method, profit split method. Each method has its own strengths and weaknesses and is suited to different types of transactions. So choosing the right method is critical for achieving compliance and ensuring that transfer prices reflect market realities. Very, very important. So let's start with comparable uncontrolled price method. The comparable uncontrolled price method compares the price charged in a controlled transaction to the price charged in a comparable uncontrolled transactions between unrelated parties under similar circumstances. Now, let's look at key consideration. The transactions being compared must be similar in terms of product or service characteristics, contractual terms, economic conditions, and market conditions. Adjustment may be required to account for differences that could affect price comparability. So when to use, the COP method is most effective when highly comparable uncontrolled transactions are available. It also works well for commodities, raw materials, or standardized products where market prices are readily available. Now, how to use it, which is the same thing as application. Identify comparable transactions. You look for similar transactions between unrelated parties where identical or similar goods or services are exchanged. Make adjustments. Adjust for material differences between the controlled and uncontrolled transactions, such as product quality, terms of sale, or geographic location. You need to adjust. For that. Then determine the arm's length price. Use the uncontrolled price as the benchmark and make necessary adjustments to arrive at the arm's length price for the controlled transactions. So let's look at example. Company A subsidiary of a multinational group, sells widgets to its parent company. Company B. The COP method would compare the price of widget sold to an independent third party by Company A with the price charged to Company B. So if Company A sells widget to an unrelated company for $100 each, the same price should be charged to Company B, adjusted for any difference in transaction terms. So you should have adjusted for that, and you should ensure that it is the price that is being sold for independent party that should be also considered. Now, another example, let's say a subsidiary sells crude oil to its parent company. The COP method would compare this price to the price of crude oil sold by the subsidiary to independent third-party customers. So if there are any differences, just like we're talking about adjustment, let's say there are differences in the quantities, in the delivery time. So if these kind of differences exist, adjustments would be made to ensure comparability. Now, the key consideration here is that this method provides a direct and simple comparison, often considered the most precise when sufficient data is available. However, it can be challenging to find appropriate comparable transactions, especially when product specifications, markets, or circumstances differ. So those are the challenges of using COP method. Now, the resale price method. The resale price method starts with the resale price to an independent party and subtract an appropriate gross margin to arrive at the transfer price for the controlled transaction. When to use this? Resale price method is suitable for distributors that resell. So sorry, let me take that again. Resale price method is suitable for distributors that resell goods purchased from related parties to unrelated customers, particularly when the distributor adds little value to the product. So this method is ideal when comparable resellers exist in the market and gross margin can be easily compared. Now, how to use this particular method with respect to application? You need to identify the resale price. Start with the resale price at which the reseller sells goods to independent third parties. Now, you also subtract a gross margin, deduct a gross profit margin from this resale price. The margin should be based on what independent distributor earn for reselling similar products. The third thing is to adjust for functional differences. Adjust for any differences in functions performed, risk assumed, or assets use between the related and independent distributor. So example, company C buys product from its related party, company D, and resells them to independent customers. If company C sells the product for $150 each and a comparable independent reseller earns a gross margin of 30%. So the transfer price between company C and company D should be 105. That is 150 less 30% of $150. Now let's look at another example where a subsidiary in country A buys electronics from its parent company and resells them to independent customers. If independent distributor in country A earn a 20% gross margin in comparable transactions, the arm's length price for the initial sale from the parent to the subsidiary would be the resale price minus the 20% margin, just like we've also used here. Now, key consideration for this is that this particular method is effective for low risk distributors with limited value addition, and it becomes less reliable if the distributor adds significant value to the product, such as rebranding or modification before resale. So that is another important thing to note when applying transfer pricing method. Now, cost plus method. The cost plus method adds an appropriate markup to the cost incurred by the supplier of goods or services in a controlled transaction to determine the arm's length price. When to use this? The cost plus method is suitable for manufacturers or service providers who add value and incur well-defined cost in producing goods or services for a related party. And this particular method works best when the supplier is a contract manufacturer or low-risk service provider. Now, how to use this? You need to determine, this is with respect to the application now, determine the cost base. You need to identify the direct and indirect cost incurred by the supplier. You need to apply an appropriate markup, add a markup that reflects what independent companies would charge for similar products or services. Adjustments should be made, or you adjust for any functional differences. Consider differences in functions performed, risk assumed, and assets used between related and independent companies. So For example, Company E, a manufacturing subsidiary, incurs $80 in production cost for a product. So if comparable independent manufacturers earn a 25% markup on cost, the transfer price to its parent company should be $100. Now, how do you arrive at that $100? That would be $80 plus the 25% of $80, which is the markup, 25% markup. That's how you arrive at $100. Now, let's use another example. A subsidiary in country B manufacture auto parts for its parent company. Now the production cost per unit is $100. If independent manufacturer typically apply a 10% markup, the arm's length price would be $100 plus the 10% markup, which gives us $110 per unit. Now, the key consideration with respect to this method is that cost plus method is ideal for standardized products or services where costs are well defined. It may not work well if the related party cost structure differs significantly from independent companies, or if the supplier assumes significant risk or owns valuable intangibles. So we need to be careful when applying this kind of method. So the transactional net margin method now, which examine the net profit margin relative to an appropriate base. For example, sales, assets, costs that a taxpayer earns from a controlled transaction. So this margin is compared to the margins earned by independent companies in comparable transactions. Let us look at when to use it. TNMM is useful when direct price comparison or gross profit margins are unavailable. So the transactional net margin method is useful when direct price comparisons or gross profit margins are unavailable, but profitability can be analyzed. It's particularly suitable for service providers, distributors, or manufacturers where precise product comparability is challenging. So we need to note that. Now, how to use it, the application. Identify the tested party. Select the related party whose net profit margin will be analyzed. Determine an appropriate profit level indicator, which is the PLI, and this could be the net profit margin relative to a base such as sales, assets, or costs. Now, you need to find the comparable uncontrolled companies. Look for independent companies performing similar functions, incurring similar risk, and using comparable assets. Now, you also need to adjust for the differences. Adjust the margins of independent companies for any significant differences in business functions, risk, or operating environment. So let's look at an example. Company F, a service provider, earns a net profit margin of 10% on sales from providing services to its related party. If comparable independent service provider earn net margin between 8% and 12%, the 10% margin indicates the price is at arm's length. So we'll look at another example of the transactional net margin method before we move further. A subsidiary provide IT support services to its parent company. Independent IT companies in the same region typically earn a net profit margin of 8%. If the subsidiary margin is 5%, adjustment might be needed to reflect the arm's length margin of 8%. And the key consideration here is very important to say that the TNMM is flexible and widely applicable across industry, but is less precise than methods like the COP method, which focus on specific transaction. It can lead to disputes if tax authorities prefer methods that look at individual transaction prices rather than net margin. So we need to watch out for that. Now, profit split method. The profit split method allocates the combined profit from intercompany transactions based on the relative value of each party's contribution to the transaction. It's useful when both parties make unique contributions that are difficult to value individually. When are we to use the profit split method? It is ideal for joint ventures or transactions involving intangibles or highly integrated operations. It is best used when each related party, or let me put it this way, it is best when each related party contributes valuable assets or functions, and determining the value of each party's individual contributions is challenging. Now, how do we use this? The application. One, you need to identify the combined profits. Calculate the total profit earned from the control transactions between the related party. Evaluate each party contribution. That means analyze the value of each party contribution, including the functions performed, assets used, and risks assumed. Determine the profit split. So allocate combined profit based on the relative value of each party's contribution. Example, Company G and Company H jointly develop a new technology, sharing development cost and risk. If the total profit from the technology is 1 million and Company G contributes 60% of the value while Company H contributes 40%, the profits are split accordingly, giving Company G $600 and Company H $400. Another example is when two related companies jointly developed a patent technology. Company A contributes 60% of the R&D effort, while Company B contributes 40%. So if the total profit from the sale of the technology is 10 million, Company A would receive $6 million, which is 60%, and Company B would receive $4 million, which is 40%. Now, key consideration of this method is that this method helps avoid distortion in profit allocation, but requires detailed information about each party's contribution, which can be difficult to quantify. It is very complex and often subjective, leading to potential disputes between companies and tax authorities over the proper allocation of profits. So let's look at choosing the most appropriate transfer pricing method. Another interesting one. Now, choosing the most appropriate transfer method. Selecting the right transfer pricing method is crucial for ensuring that transactions between related parties are priced at arm's length and comply with both local tax regulations and OECD guidelines. So, the appropriateness of a transfer pricing method depends on several factors, which we will explain now. Now, one, we need to look at the nature of the transaction. The nature of the transaction plays a vital role in selecting the most appropriate transfer pricing method. Different methods work better for different types of transaction, such as the sale of tangible goods, provision of services, or transfer of intangibles. Let's look at case study. Sale of commodities, choosing the COP method, for example. Scenario. Let's look at a scenario. A multinational corporation, XYZ Energy, operates in both country A and country B. XYZ Energy produces crude oil in country A and sells it to its subsidiary in country B for processing. The price charged by XYZ Energy to its subsidiary must reflect the market price of crude oil to meet transfer pricing regulations. Now, let's look at the appropriate method. The comparable uncontrolled method is the most appropriate method because crude oil is a standardized commodity with readily available market prices. So you can see now that we're giving proper example. Now, the COP method allows XYZ Energy to compare the price it charges its subsidiary with the price it charges unrelated customers in similar transactions, or with the quoted market price for crude oil. Now, the key consideration for this is that for commodities like oil, market prices are easy to find, making the COP method the most reliable for ensuring that related party transactions reflect arm's length principle. Now, the second thing to look at after looking at the nature of the transaction, just like we have used for commodity or for oil, in the oil and gas sector now, availability of comparables is very important. The availability and reliability, so it's not just the availability now, the availability and reliability of comparable uncontrolled transactions are critical factors in determining the transfer pricing method. Some methods like COP and RPM, which is the resale price method, rely heavily on the availability of comparable data. Let's look at a case study now. Let's look at a case study, lack of data. So choosing the TNMM where there is no data. So a multinational company, ABC Tech, develops specialized software for its clients worldwide. It charges its US subsidiary a licensing fee for using the software. However, because of the unique nature of the software, there are no comparable uncontrolled transactions available to determine the licensing fee using the COP method. Now, the appropriate method here will be the transactional net margin method, which is the TNMM, is the best approach because direct price comparison are difficult for such unique intangibles. So instead, ABC Tech compares the net profit margin of its US subsidiary with that of independent software company providing similar services in the same market. Now, key consideration: when comparable data for individual transaction is not available, TNMM is useful for focusing on overall profitability using independent companies with similar functions and risk. So another consideration is the functional analysis. Functional analysis involve evaluating the functions performed, assets used, and risk assumed by each related party in a controlled transaction. The level of value added by each party will help determine the most suitable method. So let's use a case study now, high value addition, choosing the cost plus method. So a company, global manufacturer based in country C, manufactures custom-made car parts for its parent company in country D. Now, global manufacturers incurs significant production costs and uses valuable machinery and highly skilled labor in the manufacturing process. The appropriate method for this would be the cost plus method because it's appropriate here because global manufacturers add significant value to the product by customizing car parts. The transfer price between global manufacturers and its parent company should reflect the costs incurred plus the standard markup, which reflects the value added through manufacturing. Now, when the related party performs significant value adding functions such as manufacturing or complex services, the cost plus method ensures that the markup reflects the value created. Now let's look at consistency, which is one of the considerations when choosing the appropriate transfer pricing method. Consistency with overall transfer pricing policy. Transfer pricing methods must be consistent with the company's overall transfer pricing strategy and should align with how the company handles similar transactions across different jurisdictions. So for integrated operations, choosing the profit split method now. This scenario, we're looking at two subsidiaries of Global Pharma. One is in country E and the other in country F. They collaborate on the joint development of a new drug. So both subsidiaries contribute to the research and development process. One subsidiary provides the research and development expertise, while the other funds the project and bear the financial risk. So the appropriate method here would be the profit split method because they are both contributing. The profit split method is ideal in this case because both subsidiaries make unique and valuable contributions to the development of the drug. So profit from the eventual sale of the drug will be split based on the relative value of each subsidiary contribution to the development efforts, ensuring that profits are allocated in a way that reflects economic reality. Now, when related prices contribute uniquely to the transactions, especially in intangible asset development, the profit split method ensures fair allocation of profits based on contributions, keeping the approach consistent with the company's global transfer pricing policies. Now, the last one here is the regulatory requirements. Local tax regulations and guidelines must be taken into action or must be taken into account. Different jurisdictions may have different transfer pricing documentation and compliance requirements, which can affect the choice of method. Now, let's look at a case study relating to regulatory compliance. So, choosing, let's say, the resale price method to meet local guidelines. So, retail company, a global electronics retailer, operates in country G, where the tax authority has specific guidelines recommending the resale price method for companies engaged in distribution activities. Retail Co. buys electronics from its related supplier in country H and resells them in country G. So the appropriate method, which is the resale price method, is the best choice because it aligns with the local tax regulations. So Retail Co. will start with the price it charges its independent customers and subtract a gross margin to determine the arm's length price for the transaction with its related supplier. Now, the key consideration for this is that compliance with local regulation is also crucial to avoid disputes with tax authorities. So when specific methods are recommended by local guidelines or by local laws, companies should aim to follow these methods where applicable. Now, in conclusion, selecting the right transfer pricing method depends on the specific characteristics of the transaction, the availability of comparable data, the functions and risk involved, and compliance with local regulations. The right choice ensures that related party transactions are priced fairly, minimizing risk of tax adjustments, penalties, or disputes. So through these case studies, we have seen how different factors guide the decision to use one method over another. So each method plays a critical role in ensuring that multinational enterprises achieve compliance with aligning their transfer pricing practices with both global and local standards. Thank you for your attention.